Hello, in this video, we'll be going over changes in estimate or method. Sometimes when we depreciate or amortize or deplete an asset, at some point during the period that that asset is being utilized, there might be a change in estimate. And that change could be the change in their useful life, or it could be the change in the salvage value or residual value, it's also called. When that happens, we have to account for it, and we account for it prospectively. That means that when we make the change, we only reflect on the financial statement in the current period and future periods. We do not reflect it in prior periods. We don't restate our financial statements or make any sort of a adjustment in any sort of prior periods. When you have a change in estimate within the disclosure notes to the financial statement, you should describe the effect of the change and on net income and any related per share amounts, which means earnings per share. So, like I said, the changes in estimate can be changes in the salvage value or the change in the useful life. Let's take an example. Let's say we buy machinery and the cost is $10,000, salvage value is $1,000, and useful life is 5 years. So under straight line depreciation, right, we take cost minus salvage value, and that's also the same thing as residual value, divided by useful life, and we get $1,800 of depreciation expense per year. So every year on December 31st, this is assuming we acquired it on January 1st, we debit depreciation expense $1,800 and credit the accumulated depreciation $1,800. I'm going to just go back real quick. And so I'm just going to draw my T account for my accumulated depreciation account for this account right here, right? And I will just also draw my machinery account. And so we acquired it for $10,000, right? So we acquired it for $10,000. And year one, we depreciated it $1,800. That was year one. And we depreciated another $1,800 year two. So the book value of that asset at the end of year two is going to be my cost, which was $10,000, minus my accumulated depreciation, which at the end of year two is going to be $3,600. And so my book value at the end of year two is $6,400. We'll just need those facts for the next slide. Okay, so now we're going to assume here, this is where we start, that the beginning of the asset's third year, its book value is $6,400, which is what we just did. And at that time, it is determined that the machinery will have a remaining useful life of 4 years, and the estimated salvage value will be revised downwards from $1,000 to $400. So we have to calculate a new depreciation expense using that information. And what we do, the way you do it, is you take the book value, which we know is $6,400, minus the revised salvage value. So the new salvage value or the new residual value is $400, and you divide it by the revised remaining useful life. So it says that this asset will have a remaining useful life of 4 years. So we divide by 4 years. And then at that point on, we're going to depreciate this asset by $1,500 per year for the next 4 years. That's how you calculate a change in estimate. And you just start depreciating the year that you do this change. You just start with a new depreciation and you put a disclosure note in your financials. Let's look at Oracle. They made a change in estimate, and let's just see their note. And it just said, during the first quarter of fiscal year 2023, we completed an assessment of the useful life of our servers and increased the estimate of the useful life from 4 years to 5 years, effective the beginning of 2023. Based on the carrying value, so the carrying value is the same thing as book value, It's an interchangeable term. So based on the carrying value of our service as of May 31, 2022, which is when the change was made, this change in accounting estimate decreased our total operating expenses by $434 million. So you can see the change in estimate can be very significant for a company. Now, sometimes we change our method of depreciation, amortization, or depletion. When that happens, we also account for it in the same manner as a change in estimate, which is prospectively. So we're going to change our current period, our current year forward. We do not go back to the prior period. However, when you have a change in your method specifically, you have to have a justification as to why the new method is preferable. So the reason for this is because a change in the estimate is a result of a change in accounting principle. And when you change an accounting principle, you have to say to the readers, let the readers know why you had that change. And a justification could be that a different depreciation method would better represent the pattern of the asset's consumption relative to the revenue it produces. Let's take an example. On January 1, 2025, the Hover Manufacturing Company purchased the machine for $250,000. That's our cost. And this is January 1, 2025. The company expects the service life of the machine to be 5 years, and its anticipated residual value $30,000. The company's fiscal year end is December 31st, and the double declining depreciation method is used. During 2027, the company switched from the double declining method to the straight line method. So they had in 2025 and 2026, they were using the double declining method before they switched to straight line. So let's look. The way you do this is, again, you're going to look at your book value, right, on the date of change is your starting point. You're going to need your book value minus your residual value divided by your remaining years, your remaining useful life. So what's our book value? Our book value, we know our book value is book value, equals the cost minus your accumulated depreciation. That's book value, and that's what we're calculating here. So here our cost is $250,000. Our cumulative depreciation, we have to calculate the depreciation for the first 2 years. Using the double declining method, we take our cost times our depreciation rate, which would be 1 divided by 5, because it's a 5-year asset, which is 20%, but we double it, because this is a double declining method. Would give us depreciation expense in year 1 of $100,000, and then in year 2, we would take our cost minus that $100,000, multiplied by that $40,000. So year 2, our depreciation expense was $60,000. So total depreciation for year 1 plus year 2 is $160,000. So our cost is $250,000. Our accumulated depreciation is $160,000. So our book value on the date that we want to make the switch is $90,000. Here it says undepreciated cost as of 1/1/2027. That's the same thing as book value. That's what the book value represents. So I said book value minus residual cost. You're going to take that $90,000 minus residual cost is your depreciable base is $60,000. And then we're going to divide it by the remaining life. So it was a 5-year asset, right? Because we on 1/1/25, and we've already depreciated 2 years. So we have 3 years left. Oops. So we have 3 years left. So that's right here. So you're going to take your depreciable base, divide by your remaining life, and then your new annual depreciation is going to be $20,000. And you're going to record that $20,000 from the next 3 years, which is the remaining life of that asset. You just do debit depreciation expense $20,000 and credit accumulated depreciation $20,000. we've taken, this example is specific to change in depreciation method. If we can also do a change in amortization because we feel that a different sort of the life of that intangible asset might be better using a different method. So this is depreciation, but the same rules apply whether you have a change in method for intangible assets or natural resources. Here's another note from the Lionsgate Entertainment Group. The company changed its pattern of amortization, so right, of its traditional affiliate customer relationship intangible asset from the straight-line method over 17 years to an accelerated amortization method, and it says, which reflects amortization in the proportion that the current period revenues bear to management's estimate of future revenue over the remaining estimated useful life of the asset. So this tells you the why, right? That was the why. Oh, my pen just changed colors. Okay. And then it says, this change in amortization method resulted in an increase to amortization expense of $38.7 million. And so this is the how much of what changed. And it says, with a corresponding increase to loss before income taxes, net loss, and net loss attributable to Lionsgate Entertainment Corp shareholders. So it tells you who it affected, and essentially when it says it's going to be a net loss, your earnings per share is definitely going to go down.